Let's go to September 1992. A junior trader at the Soros Fund Management helps coordinate the largest currency speculation in recorded history. The bet is that the Bank of England cannot defend the pound. The fundamentals say that it's not going to happen and won't allow it. The pound eventually breaks. Britain exits the European exchange rate mechanism in a single day. And Soros walks away with over $1 billion. So, what we're going to be covering is what that is, the architecture in general. So, the whole architecture and why the $650 billion in artificial intelligence spend is reading about the mechanism the exact way that I'm saying, right? This is not a politics video. This is a macro mechanics video. So let's go. Segment one here that we're getting into is going to be about the paper called A User's Guide to Restructuring the Global Trading System. The author is a Stephen Miran, who is now the chair of the Council of Economic Advisors. The phrase Mar-a-Lago Accord was coined earlier by a former Credit Suisse strategist, Zoltan Pozar. Moran's paper turned the phrase from a clever headline into a policy architecture. Most of the financial press has cited it. Almost none have integrated it into how they cover the administration day to day. The United States runs a persistent trade deficit, not because Americans consume too much, but it runs them because the dollar is structurally overvalued. The dollar is overvalued because the foreign central banks have an inelastic, price-sensitive demand for dollar reserve assets. Every central bank that needs reserves holds treasuries. That forced demand props the dollar above any level domestic fundamentals would support. So the result is that manufacturing bleeds out over decades. Financial sectors inflate and the pattern calcifies. The three instruments on the screen here that you're getting a glimpse of are the controlled dollar devaluation. As I said, you bring the dollar down in an orderly way to level out where American manufacturing can compete again, idealistically. Two, you're going to force debt restructuring. You're pushing foreign official treasury holders into longer dated instruments, century bonds, or charge them a user fee on interest payments. In contract terms, this is a selective default. Miran calls it a necessary rebalancing. Three, a word I'm sure you're very familiar with, is that tariffs and security guarantees are used as leverage, or use this as leverage in general. The stick, if you will, that makes allies agree to any of the above and lose access to the American market and the American security umbrella or come to the table in general. How far along is this general plan? The Council of Foreign Relations published an analysis in January 2026. They noted that several of Moran's proposals had already materialized as policy. Three more flagged as increasingly likely near term, and currency intervention or closer Treasury Fed partnerships to cap Treasury yields and taxes on foreign investment. The trade weighted dollar fell roughly 9% in 2025. By Q1 2026, the dollar index had lost more than 10% year over year, touching multi-year lows. That is not an accident. That is the trade working itself. As I bring this up for your screen to see, you get a glimpse of the outline of how exactly the trade is working from the visual and the information I've kind of broken up for you there. In 1992, Bessent was betting against a policy that could not hold, and the British government had committed to defending an overvalued pound. The fundamentals said it was indefensible. Bessent and Soros positioned accordingly. Now he is not defending; he is repositioned entirely. Right. The strong dollar, quote unquote, Bessent repeats strong dollar policy in like every interview. And at the same time, the administration is implementing full spectrum architecture, tariffs, stablecoin legislation, bilateral diplomacy, Fed pressure. The cumulative effect is a weaker dollar. When a CNBC host asked Bessent to reconcile his strong dollar rhetoric with Trump's public celebration of the dollar's decline, Bessent called it a false choice. That response is not a dodge. It is the trade's stated position. A strong dollar in Bessent's framing is not a defended price. It is a set of underlying fundamentals. Fundamentals that produce a weaker nominal exchange are not a failure of dollar policy. They are a success of it. So the 1992 pound situation, the 1997 Thai baht, the 2015 currency for Chinese yuan managed peg. In every case of these situations, the state said one thing about the currency and did an entirely different thing. Private capital was ahead of that. They noticed, they positioned themselves correctly. The currency moved to where the fundamentals already pointed. And that's what they're expected to do in realistic markets. So he is now using the exact same pattern on purpose from inside, right? And again, this all ties back to the refinery paradox. If you haven't already checked that video out, the link is in my bio, or it's also in the videos. Hopefully it's on this one as well. So when it comes to the orderly devaluation architecture, we'll kind of talk about how Miran's paper says explicitly that the orderly devaluation is one that does not trigger reserve asset panic. The strong dollar policy statements are not misdirection. They are a tool for observing or absorbing adjustment over time. They keep foreign reserve holders from panicking. They keep domestic markets from pricing in a cliff. This is the first time in American Treasury history that a secretary has brought this specific kind of career knowledge to this specific kind of mandate. Kind of went through that about, Scott Bessent and his career, right? When he's the perfect person for the role. Anyway, let's go over, July 2025, right? The Genius Act being signed into law. Most headlines covered it as a stablecoin regulatory situation. The crypto industry got clarity, banks got a framework, and Coinbase and Circle got a win. Read Bessent's own statement, right? Go back with the macro trend lens here and read that. He framed stablecoins as an internet native payment rail that would support the dollar's reserve currency status. And then he said the operative part, right? That the bill would derive demand for the US Treasuries because stablecoins require Treasury collateral. The mechanics of this are quite interesting. They translate that from English into macro English. I would say that every dollar is regulated stable coin issuance, and that requires by statute a matching dollar from the Treasury, as he said. Interesting point is that specifically as a stable coin market grows and the administration has publicly projected into the multi-trillion range, the stablecoin sector became a massive new force, non-state buyer of short duration US debt. That demand does not come from foreign central banks. It comes from people holding digital dollars on their phones or whatever. In Lagos, in Jakarta, in Buenos Aires, like, this is an elegant situation for the portfolio, as I was putting here back on the screen, because Miran's paper is fundamentally about reducing the weight of the forced urine official Treasury demand. The forced demand is what overvalues the dollar, but if you push foreign central banks out of the market without replacing their purchases, rates spike and the debt becomes unserviceable. Stablecoins are the replacement buyer, domestically regulated, dollar dominated, not tied to the foreign sovereign's policy choices, structurally separate from the reserve currency function. If you can lean on foreign officials, holders to restructure the Treasury positions via Miran's user fee mechanism situation or century bonds, while you're doing that, the stablecoin sector backfills demand at the short end of the curve. The result is that a weaker dollar Basically, the result is a dollar as reserve asset paired with a stronger dollar as payment rail situation. Moran's paper argues that those two functions can be separated. The Genius Act is the separation mechanism, and of course, at this point, it's already law, right? So as we get into segment 4 here, the hyperscaler CapEx picture, we're going to talk about the $650 billion bridge, that extends to your desk as well. In February 2026 alone, Alphabet, Amazon, Meta, and Microsoft collectively announced CapEx guidance approaching $650 billion. Okay. Add Oracle, closer to $700 billion. Amazon alone, $200 billion. Alphabet, 175 to 185, a 60 to 75% jump from 2025. The vast majority goes to AI chips, servers, and data center infrastructure. Amazon's free cash flow significantly negative in 2026. Morgan Stanley models a $17 billion deficit. Bank of America's model is closer to $28 billion loss. Alphabet's free cash flow projected to collapse roughly 90%. So Meta issued $30 billion investment grade bond deal in early 2026. That was the largest of the year. Big tech collectively issued around $100 billion of debt in Q1 2026 alone to fund the build out. Bond market participants demanded record credit default swap protection on the resulting paper. As you'll look at your screen here, tying this back now, the dollar depreciation, GPU cost rise into the tariffs, higher landed costs, into the stickier inflation and rates that stay high. So a weaker dollar makes every imported GPU more expensive in dollars terms, right? So debt stays expensive. The refinancing cycle on the 100 billion of AI bonds gets harder, not easier. Hyperscalers can absorb that. They have a combined $420 billion in cash. They have an investment grade access. They have sufficient political importance that administrations has reasons to protect their build out. Your enterprise does not, essentially, which for the rest of us, this is what the theory, the refining paradox breaks down more for that. So the operational translation, to be specific for this, is that your AI CapEx assumptions are being repriced right now. If you're on a 2026 budget was built on 2025 unit economics for GPU-backed workloads, 10% dollar move plus tariff effects on imported hardware plus sticky input cost inflation on data center power and cooling, that does not show up on a line item called macro trade. It shows up in your hyperscaler renewal quote being 15 to 20% higher than you modeled. Build versus rent calculus has certainly started flipping. For 3 years, the enterprise playbook was build where you have defensible moats and rent everything else, right? The rental side of that equation assumed cloud pricing would decline on a unit basis. It is not going to. Hyperscalers are spending 94% of operating cash on CapEx. They will recover that through their price. Okay. Your build is getting harder at the same time. If you are planning on on-premise inference infrastructure in the next 18 months, every component is being dollar repriced, tariff repriced, and in some cases supply ration because the hyperscalers have first call volume commitments with NVIDIA and TSMC. The macro forced outcome is consolidation into hyperscaler platforms. The enterprise playbook quietly collapses from build where it matters, rent the rest, to rent everything, negotiate for survival. The $2 million AI pilot that you are defending to your board is going to be a footnote in a macro war you did not know was happening. The person that is running that particular war is in the U.S. Treasury building. He is not in Mountain View, California. As I kind of close here, Scott Bessent has spent his career betting against states defending policies their fundamentals could not sustain. He is now the state, right? What that means is the Genius Act is not a crypto bill. It's a Treasury demand replacement mechanism that's already law. The $650 billion hyperscaler CapEx is a transmission or the transmission mechanism. It is how the macro trade teaches all of us what's really going to happen and how your AI budget will be affected. I am not saying this trade will be successful. Moran's framework has serious critics. The dollar adjustment could become disorderly. Foreign reserve holders could panic instead of negotiate. The stablecoin market could grow more slowly than projected. So, what I'm saying is that the architecture is real, the instruments are in motion, and the dollar has already moved. Whether the thesis confirms or breaks, the correct response for any leader managing AI strategy right now is to stress test your cost assumptions against 10 to 15% dollar move and elevated rates, in my opinion. If you want to be a part of the monthly signal tracker from Substack, make sure you go to the link in my bio. I call it the Bessent Signal Watch. I start that next month, May. So you only got a couple days here. It's part of the refinery paradox and the refinery report of my Substack. I'll be tracking swap agreements, stablecoin treasury absorption. Again, the link will be in the description. If you have anything that you want to share, drop a comment. Let me know what you think about these ideas as well. I'm not here to tell you what to think about the policy. I'm here to try to make you understand what it means for decisions that you will have to make in IT leadership or in senior leadership, corporate America, corporate global. So, yeah, what's the biggest assumption that your current AI budget will break your AI budget if cloud pricing goes up 20%, or especially because of gas prices, wherever that lies? Drop a comment, let me know. But yeah, until then, see ya.